So I start. A very good evening to all of you, and welcome to the webinar on recent GST reform, which has brought about significant changes in the insurance industry. And I'm very happy to have so many of us, different stakeholders being very enthusiastic about the subject and wanting to know what its implication is. It's really a welcome move to make insurance more affordable to the common man. And prima facie, we would think that it will be give a greater fillip to increase insurance penetration and reduce the protection gap, especially as a part of insurance for all by 2047. Urban India would also be able to buy more cover at the same cost. But given the complexity of the insurance business, there is more to it than meets the eye, especially in terms of the full impact in the short, medium, and long term. And I, President of the Institute of Actuaries of India, am very, very happy to welcome all of you. Happy that we are hosting this webinar, facilitating discussions between industry experts on the implications, challenges, and opportunities these reforms bring. We have key stakeholders being represented across the board this evening. We have people from tax experts, we have experts from finance, we have experts from the actuarial field, both in life and property casualty, health and reinsurance. So without much ado, I would like to hand it over to Kunj, who will take you through the proceedings for the rest of the webinar. Over to you, Kunj.
Thank you very much, Preeti, and thanks a lot for everyone to join, especially our guests and especially our external guests, Nilesh, and who's joined us as CFO. I'll quickly introduce all of our external guests first, and then move on to the actuarial people that I'm sure all of you are very familiar with. So, Paresh, if you could just move the slides further, and all of us can be introduced. Nilesh Kamli is the CFO at Star Health, and he's a professional with more than 17 years of experience. He's very graciously accepted to be part of this conversation, which for us is an experiment, and hopefully for him is a good interaction with the actuaries abound. We're also joined and very thankful to Piyush Bihani, who's partner at Deloitte and has been working with life insurance and general insurance and health insurance companies on GST related matters for more than a decade. And I had a brief opportunity to speak with Piyush before this, and it was evident that he drips with the subject matter expertise on GST. So hopefully all of our actuarial community will have an opportunity to pick his brains, get his insights on what it means from a technical perspective at the tax authorities and what's been intended with the change. We also have and are waiting for maybe Divyesh. I'm not sure if he's joined immediately. If not, Rajesh, if you could just actually message him. I've messaged him a little bit. Divyesh is.
I'm here.
Oh, hi, Divyesh. Hi. I'm still not able to see you, but thank you very much for joining. Thank you very much for joining. Divyesh is partner at EY on indirect tax and has more than 23 years of experience. So he comes with a lot of deep expertise in these areas. So very, very special thank you to all three of you. The reason for the special thanks is not to lessen the thank to everyone else, but more because you are our invited guests into our professions conversation. So thank you very much for joining, and we look forward to your expertise. Then we also have our esteemed member of our own profession. So hopefully many of your audience members are already familiar with. Preeti, of course, our president, and Anurag, our council member. And thank you, Anurag and Preeti, both for actually encouraging this experiment. This is intended to be an experiment where actuaries can come together, have a free conversation about matters impacting our industry and how to really go about it. So in some ways, we all accept that nobody is a complete expert, but we're all having to deal with a situation that has arisen. And we all put in our collective thoughts and collective minds in terms of finding, there'll be no perfect solution, but at least finding possible ways of navigating this change. So thank you very much for your encouragement, Anurag, and thank you very much for your encouragement, Preeti. And very warm and special thanks to Pritesh sir, whose only response when I asked him to join this was, I cannot say no to you, which is great. And I hope that continues for as long as possible. And Pritesh is appointed actuary at SBI Life. I think all the members in the actual profession know him as the humblest, quietest actuary. So it'll be wonderful to listen him speak. Usually he's the quietest person in an actuarial room, and it'll be wonderful to get his thoughts because when he does speak privately, he's full of insights. And I can promise you that, you will normally find Pritesh being quiet and listening. And when he speaks gems. So we look forward to the gems from you, sir. And joined with my very good friends, Bhavna and Ashish. We've been ex-colleagues, and Bhavna now as appointed actuary at India First Life, who volunteered happily and come forward. So very, very encouraged by both Ashish and Bhavna, who came forward and said, yes, we would like to participate in any such conversation. So thank you very much for joining, Bhavna. And Ashish, who probably has one of the toughest jobs in the industry, which is managing all the technical actuarial work with in, integrating that with the understanding of external investors and analysts and all the people that he needs to interact with. So Ashish and has been, we've seen many insurance companies come out with their impacts and so on and so forth. So Ashish has been in his organization at Max Life, sort of leading the change on GST thinking on what to do. So thank you very much, Ashish, for joining us as well. And I'm equally glad these are our, life insurance, let's say, folks. Equally happy that Prasoon, who's the appointed actuary at ICICI Lombard, encouraged by, of course, Anurag, who's been able to join us, along with Rajesh. And Rajesh needs no introduction in this forum, as an ex-president of the institute and also a partner at EY, and hopefully he's a stalwart of our profession. So no introduction needed there. Um, and I think last but not the least, I usually the director or the person who's the most important comes, in the movie credit comes last is Sanjeev sir, with again an ex-president of the institute. So we have three ex-presidents here, current and ex-presidents here, and he's the chairperson at Gallagher Re. So thank you very much, all of you, to join. As I said, this is a little bit of an experiment where we're trying to have a freewheeling conversation on matters of importance to our industry, GST being very important one. Um, I think of it a little bit like, all of us gathering around a chalk, and it's a digital chalk, and having a conversation as you would in a chalk. So Priti, thank you very much for joining. I will maybe start with, let's say, the external participants here. And maybe Piyush, if you could shed some light. I know since the announcement by um, the finance minister, there has been, scrambling of activity going on in terms of Life Insurance Council, General Insurance Council, IRD representations, and so on and so forth. Everybody is sort of scrambling to first understand what's happening, and then also putting in their point of view to the ministry and to the finance. So, what is the latest? What has happened? There have been some meetings in the afternoon today. What's really happened since the announcement, and what do you make of the facts of the current situation?
Thanks, Coach, and thanks everyone. A very good evening. Good evening to all. Special good evening to fellow participants Nilesh and Divesh, as well as Rajesh. I'll just process what has happened. Help you guys process actually what's happened over the last week or so. The announcements, we were more or less a party to giving the data to the government for getting this relief out for the sector. And similar exercise was happening across other sectors as well. Uh, there were three exemptions or three rate reductions that were offered to the insurance sector. One being the motor TP rate for goods carriage being reduced from 12% to 5%, along with an entitlement for the GST input tax credit. So that's more of a rate change that we have seen. On top of that, there were other two changes which were mentioned, which is exempting, so no levy of GST in case of individual life insurance services and no levy of GST in case of individual health insurance service. This was the short and sweet announcement that came out from the FM's office after the conclusion of the 56th GST Council meeting. There were FAQs that the GST Council issued at that point, life insurance as including ULIPs and endowments and individual health insurance products. Subsequent to that, before we ponder into the challenges that the industry is facing in terms of interpreting these two, three lines that have come out, the developments that have happened is not only insurance, but all sectors within the economy who have been impacted with this rate rationalization exercise. As a part of this, the chairman CBIC was kind enough to oblige all the industry representatives and bodies over a period of 3 days, which started from 10th. So from 10th of September till today, every day on an average, there are 4 meetings that are being conducted with the chairman CBIC, apprising him of the challenges that each industry is facing. So for example, peculiar to FMCG's requirement to pack, repack, inability to reduce the price in terms of paisas because of lack of coinage in the country, how to handle those things, and so on and so forth. Four such meetings with different sectors, FMCG, e-commerce, etc., happened day before yesterday, and few of such meetings also happened yesterday. The meeting for the Insurance Council, the Life Council, and the General Insurance Council happened today at 3 to 3:30, along with member from the Department of Financial Services. We are yet to hear a conclusive verdict from the meeting, and maybe we'll get those insights as well. Observed or we have got to know as part of the other meetings that have happened is there is some 5 or 6 general viewpoints that the CBIC chair is communicating. One of that is that the rate reductions notification will take some time to be issued. We are expecting such notifications to be issued by around 18th, 19th of September, so pretty close to the implementation deadline. Second such thing is that it is mandatory and not optional to pass on the GST rate reductions to the consumers. Organizations are mandated to demonstrate a clear intent of passing this rate reduction, and they have to publish such rate reductions on their websites and do proper communication of the before and after pricing, so that this rate reduction is clearly visible and the government intent is demonstrated. However, on certain instances, the CBIC folks have been clear in expressing agreement towards a price increase if it is required to be done. So that's an important thing. Not every price increase would be looked at as a profiteering exercise, is what is getting communicated. There is going to be a GST Bachat Utsav that the government is going to start from September 22, where they're going to promote this GST rate reduction exercise, and they're anticipating that there will be a upcoming Diwali season. So that's more of these, hearing exercises that the CBIC is doing. As part of the life and the general insurance sectors, you would have anyways read the asks that have gone out peculiarly in terms of life insurance sector is asking for zero rating of renewal premiums because there is no ability to reprice long-term contracts that exist. Uh, Significant part of life insurance business becoming exempt impacts the accumulated input tax credit balance that's there with the life insurance company. So there is also an ask on clarifying on what to do with the accumulated credit balance. And thirdly, which is a GST exemption, or maybe asking for a lower rate of 5% on commission expenses. As all of you would know, that while giving exemption to the individual life and health policy, the government has also given an exemption to the reinsurance for these policies. So similar to that, the ask is that also give us an exemption on the commission that is being charged at the time of sale of these policies. When we go to general insurance, the general insurance of commission being exempted or reduced to 5%. On top of that, the sector needs a lot more clarity in terms of what should be included in health insurance. Now, this is quite peculiar because while the IRDA definition seems to include personal accident and travel within the scope of health insurance, the GST scheme of classification differentiates it. Now, how to read that? So that's a clarification that has been mentioned before the CBIC, along with an additional clarification as to what would happen in terms of group products, what would happen in terms of master policyholder arrangements. So, more or less seeking a confirmation on the fact that whether this exemption of health insurance would apply only to pure play standard products, which are in the nature of indemnity products, or it would also apply to benefit products that exist. So that's a sum and substance largely of what has happened in terms of the interaction from the CBIC and a response from the regulator in association with the industry. Now, how we're looking at it is quite interesting. There are these nuances, like I mentioned, personal accident, travel, etc. Be that maybe whatever these nuances are. The conclusion is that after 22nd of September, there is going to be a wider portfolio for each player, which would not be liable to GST, which would be exempt. Now, what the law says is if any product is exempt, then the GST that you pay for the procurements meant for that product will not be available for offset, which means before 22nd of September, whatever commissions we were incurring, whatever, let's say, TPA cost we were incurring, there was a GST that was getting paid on it, which was available as a credit for offsetting. So we never used to account that GST as a cost for the purpose of product pricing. However, post 22nd of September, since the outward product, the direct premium would be exempt, the GST that will be paid on the procurements meant for this direct product, that GST will become a cost. This therefore largely suggests that the cost of commission for that particular LOB, now it's difficult to segregate at the balance sheet level between group and life, but generally saying that for the particular LOB, the cost of commission as well as the allocated OPEX will increase by 18%, and this might necessitate some sort of a product repricing or let's say a renegotiation of expense exercise that will have to be done.
Right. So actually, Piyush, this is quite interesting. You say that in terms of the out-of-pocket expenses increasing for insurance companies. So can I lob it over to our colleague, your colleague here, to Piyush? So, sorry, Divyesh. I meant Divyesh. Yes. So, if I can lob it over to Divyesh, Divyesh, how do you see this increase in out-of-pocket expenses that is going to happen potentially for insurance companies, and how two things. First, what steps they need to be able to quantify it properly. Like, first you need to know, okay, if my expense is going to increase, then how much, and related to that, is there anything in the technical, let's say, rules or the fine print or anything there that, insurers can take the benefit of in terms of, it's not a direct 18% impact of all expenses, but really something less than 18. Is there anything there within the rules to take benefit of and be aware of? So, how to go about the quantification and understand what's the fine print?
So, if I can start by being a little amused by your question, Kunj, because typically we've been going to the actuary to tell us, okay, how do you do this now? But having said that, I'll answer the toss of your question. So the way we look at it is that, and possibly the way to look at it in my view is that you break it up into life, health, and multi-channel general insurance, right? So life insurance companies, a significant portion gets exempted. Standalone health insurance, a significant portion gets exempted. Multi-line general insurance, a part of the portfolio gets exempted, right? So the impact on each of these is slightly unique and different from a actuarial and a pricing impact standpoint or a cost impact standpoint. Now let's study life. When we look at life, again, there are no, there is no published data to back everything, but this is the actual understanding I have, honestly, that the first year expenses of any policy is always high, and the trail is much lower. Now, on an average, the first year expenses could be 50 to 60% of GWP. And I'm excluding reinsurance for now because reinsurance is exempted, right? And from the second year on, the trail will be, let's say, 5% of GWP or renewal premium. Okay. So if you're looking at 50 to 60%, there's a straight 10% hit of GWP because 18% of 50 to 60%. So 10% hit of GWP for life insurance companies for new business. Now, because I'm doing new business, obviously I will have to determine whether I want to reprice. Correct. The general mood or understanding, even at the government level, is that there will be some upward pressure on the price. The way government looks at it, and for example, in today's meeting, the discussion that happened with LI and GI companies, the feedback is that this point was brought up. And the way government looks at it is that, yes, we understand that there will be some upward pressure on you, but today the customer cost is 118. Okay. Yeah, if you have to change the price by certain percentage, it will still be lower than 180 because I'm taking away the tax. So I'm taking the larger hit, right? And we are hoping that market forces will compel you to not overreach and eat into what we are wanting to give to the consumer. But that's your new business for life. Your renewal business for life, if it is only 5%, then you're looking at a 80 basis to 90 basis points impact. Okay, of course, on a long-term basis, because you may have a 15, 20-year life left. But there is a 80 to 90 basis points impact, which you cannot reprice because your premiums are locked contractually. Now, is that material enough for you to reprice new business differentially? Is the decision that life insurers and actuaries or life insurers are sort of doing right now. Again, the approach is driven by protection and not by profiteering. When you look at a Sahi company, and Nilesh is here, so I obviously defer to him. But when we look at all the Sahi companies, standalone health insurers, we see an impact of maybe 6 to 7% or even more. And the reason is that even if you take out reinsurance, this is the only business they do, and therefore they are going to get hit not just by commission costs or TPA costs. They will also get hit by all the overhead of the business. A disproportionate majority is likely to move towards individual health, and therefore the impact can be quite sizable. And when I move to multi-line GI companies, we may have a 1.5 to 2% reduction in the impact as compared to a Sahi company because they have much wider businesses to spread their impact, right? So that's let's say that is the impact at headline level. Now, what is the industry doing about this and what they should be doing? So Piyush touched upon this, and there's a lot of drive that is happening around this point of talking to the government to understand their mind of what is the purpose that you're trying to drive. Okay. If you're trying to drive the purpose that individual life and individual health, which are contractually determined and negotiated with the individual, should be exempted, then you need to focus only on that. So if I'm doing a direct contract with an individual, he's coming through my agency network, my broking platforms, my insurtech platforms. Yes, maybe that's really what you want to exempt. But there is also a business that I do, which, see, at the end of the day, it is always individual health and individual life. Even if you have a group product, it's always individual at the end of it, right? So if I have a group to retail product, which are products where the group is the chassis, those are not classically individual health retail products. Those are products where the group has created a framework, negotiated a framework, which is applicable to all. The participant doesn't have a choice, right? So if the intent of the government is not to cover this, which does not seem to be, and that's the point that we are pushing in our advocacy, then the numbers that I quoted to you will reduce, because then the breadth of business that gets impacted is lower, and therefore the actual complication is lower. Now, let me give a example, and I'm sure all of you know it better than us. But take credit life, for example. Credit life is such a popular product in life. If that attachment product becomes a retail product, the impact can be quite significant of the coverage of new business, and you spend top dollar on new business for credit life, right? So your numbers will move quite dramatically on credit life, and the cost to consumer will also move quite dramatically on credit life. But if you were to exclude credit life, then you're only looking at direct sales of ULIPs, endowments, and terms, which the impact narrows down. So that's the way, Kunj, to look at it. And so I'd conclude by saying that when we are working with some of the people on this call and their teams, we are working with these two scenarios. We are saying if the representation goes through, then what's the repricing? If the representation doesn't go through, what's the repricing? And like Piyush said, the indication is notifications will come out only very last minute. And actually is only one part of our problem. We have technology, we have policy admin, we have everything to change, right? The travel guy who's booking the policy at 12:01 a.m. on 22nd September sitting at the airport should get the right tax. So all the parts of the organization, including actuaries, are working with these two scenarios to really prepare for the impact.
Okay, that's excellent. And you did call out Nilesh from a Sahi perspective, and that was quite interesting what you said. And I'll also let Anurag chip in there a little bit. Nilesh, in terms of what Divyesh was talking about, in terms of the actual, let's say, quantification of the increase in the out-of-pocket expenses. Now, I don't want you may not want to share the exact precise amount, but actually, what is the process? Like, what are the bits that you're looking at? This is the process of me being able to now look at the overall impact. And is that impact, let's say, a pure P&L item, and it only goes, below the line of, let's say, the combined ratios and expense ratios? Or is that impact something that feeds back into the combined and the expense ratios, and therefore will need to feed back into the premium pricing and so on and so forth? So that'll be quite interesting to hear from you, in terms of how are you really going about? And I'm sure you are having at least 16 meetings a day on GST. So, what's really going on there?
If I could just add a small question to this, Nilesh, I mean, it'll be very helpful if you can really pinpoint what are the heads of the financials that will get impacted. Is the loss ratio going to be impacted? Is the commission ratio going to be impacted? Is it the EOM going to be impacted? The combined ratio, the P&L profitability, and the solvency ratio in terms of the impact on the available solvency. So which parts are going to be impacted, and then we'll discuss what potentially could be a solution for each one of them separately. Thank you.
Okay. Thanks, Anurag. Thanks, Kunj. So I'll start with a slightly broader perspective, and then we'll narrow down to the question. So one is, we spoke about the benefits to the customer. We believe it's a very big change, from an 18%, which was more a luxury tax, it is 0, where the government is indicating that this is no more a luxury or a comfort, this is a necessity. And that we believe will help to change the behavior of the customer towards health insurance, that it's available. One more thing, while it will improve the penetration of new customers, it is also available to the existing customers. And what we have seen is the loss ratio typically keeps on increasing because the renewal customers also keep on dropping off, the good customers. And with this kind of a benefit available, we believe if renewal customers in 1 to 3 year bucket, the persistency improves, I think that will have a very big impact when it comes to the loss ratio of the portfolio. So there are certain positives. even the GST on medical and the pharmacy bills is reduced. I think that benefit will also come to the reduced hospital bills. So while we talk about the possible impact of ITC, I think there are a lot of benefits which will be available. One more thing which I strongly believe is while group insurance it is not available, and especially the employer-employee, I think it creates an arbitrage of 18% when the solution is available to the corporate group and the retail portfolio. So can the actuaries and the company design products which are retail in nature and there is a pricing arbitrage? I think some innovative solutions again can be given.
So I guess
When it
Prasoon,
comes-
Prasoon, that's a direct question to you then, right? Can actuaries design these innovative products? So do you want to chip in onto that?
Yeah, I mean, sorry, my video has some problems, so I'll just keep that muted. I hope you can hear me. Yeah,
Yes,
I
we
mean,
can.
so I completely agree with Nilesh. I think the line items they talked about, of course, the individual health, including family photo plans and senior citizens. So senior citizens also, I think, was always a top agenda for the government. I think this is a great initiative towards that to give them the relief. In terms of the impact, I think I agree with Nilesh. I think in terms of benefit, of course, the medicine cost. Medicine being a component of the total claim cost, medical devices, medical apparatus, and whatever whatever little bit of relief. So there is a relief on that front. But equally, as I said, I think Nilesh also explained because now there are no input tax credit, but you are paying the commissions and the GST. So there is an impact on that front, and in the common cost actually. No, as of now, obviously, we'll have to look at the overall objective of this. So it's too early to say that, innovative products, but innovations in what form? So for example, if now the question is, how do we offset the impact? There is an impact, net impact, definitely. If you look at from the pure health insurance perspective, but how do you offset that? Do we bring higher yield through a lot of add-on covers? Which makes sense or does not make sense to the customers have to look at. So I'm saying obviously insurance companies would be looking at from that perspective, in terms of giving benefits at the same time offsetting the impact, which is coming through in the PNL. But in what form is something to be seen, and how beneficial to the end customers have to be seen.
Right.
Sure.
So that's interesting. Can I just make one quick announcement and maybe request Divyesh and Piyush and Nilesh and all of the other participants as well that are speaking. So as I mentioned, this is intended to be a little bit of a digital chalk. And what happens in a chalk is also people have side conversations. So please feel free to have those side conversations in the Q&A box, in the chat box, and please feel free to put in your comments, because I'm sure whatever is being talked about, there'll be many views that you as participant. We have 275 of you now, so thank you very much for turning up in those numbers. Please feel free to put in your messages on the chat box or the Q&A box. And may I also request all of our panelists and speakers, as we listen in, we can always respond to any interesting comment or a chat that comes in. So we can always feel free for that. So go on, Anurag. Sorry, I know
Okay,
you were
no,
about to
no,
say
thank
something and say that.
Oh, thank you, thank you. Well, thank you very much, Nilesh. I think you brought a very, very important perspective, and thanks to Prasoon as well. So, Nilesh, back to you. I think from a sales perspective or from a consumer perspective, I think nothing could have been better in, I would say more than a decade to what has happened to health insurance. That could really push the health insurance board in terms of the penetration, as well as the customer's ability to buy higher sum assured covers, and it will be much easier for you to now transition people from a 3 lakh sum assured to a 5 lakh or 5 lakh to 10 lakh. But there's also an associated question, and again I come back to that. I think Devesh talked about an impact of 6 to 7%. I had estimated for general insurance somewhere around 4%, and for health insurance about 6. So the number is somewhere around 6 to 7% for health insurance. I do appreciate the some benefit that may come to you in terms of the reduced claim costs. but the component is relatively small on the consumables. The GST that are reduced. How much offset will it provide? I don't know, 0.25%, 0.5%. Still, there's quite a big gap needs to be covered, and I wish the sales grow, and we all hope that the health insurance penetration will grow. That means that's 6%, 7% applying on a larger volume. What do you think could potential? Number one, we talked about you said that EOM could go up potentially, right? Loss ratio could potentially come down a little bit, but EOM could go up. What do you think will be the impact on commission ratio? Do you think commissions are likely to come down? Will the industry try to recoup some of this from the distribution cost? What potentially could be the impact on the available policy margin, and so the impact on capital? And when the EOM goes up, we know that the IRDA came up with the EOM regulations a couple of years back, and quite a few players are struggling to bring their EOM below the allowed permissible limit. So these are a couple of questions, and would like to have your thoughts on this.
So EOM, I'd like to answer first. It's interesting. So under EOM, there are certain definitions. There is a definition on charges, which does not include income tax or GST charge. So EOM does not include any charges, and charges includes this income tax, GST. So one will have to see, and because this is something which is not beyond control of the insurance company. So whether it will get added in the calculation on the EOM, I strongly believe that the answer is no. And hence, at least from an EOM compliance point of view, this will not get added to the limits that are set in when it comes to 35%, while it will be an P&L impact. As Divesh mentioned on the second point, there are certain representations getting made to the government in terms of reduction of agency commission from 18 to 5% kind of thing. So we'll have to wait and see, what is the outcome of those discussions to have a true impact when it comes to the P&L and consequent action, which, either we are able to recoup it from the agents, we go in for a price increase to negate this impact. Similarly, what are the benefits coming in from increased renewal portfolio? So everything will have impact. It's 5 percentage points. So 1 or 2% from each of these buckets will ensure that it is P&L neutral. It cannot come from a single bucket kind of a thing. But yes, it will have an impact in increasing the combined ratio if nothing comes through, and there is a direct impact of the ITC. It will impact the solvency because the profits will come down, because 4 or 5% on the combined ratio is a very big impact when it comes to the loss of ITC. How to recoup it, what are the changes, is something which we are closely monitoring. See, one more important thing is, with ITC not available, one has to look at all the expenses as well. The insourcing versus outsourcing discussion is started, because earlier the outsourcings were cheaper, but now with that 18% arbitrage, again, one needs to see at that and see how we can reduce the impact, because with telesales, with PPA work and all that, there is a huge outsourcing which is happening. So multiple things, which each one is looking at, but there are options are available to keep on reducing the impact and mitigate the whole thing.
Sure.
So if I can just add to what Nilesh is sharing,
Sure.
just as a wider conversation with more GI and health companies, especially. I think the including life for that matter, that the whole push from this sector to say that you need to now rationalize rates on commission is so at least the feedback from today's meeting that happened in the afternoon is that the government doesn't have room to do it right now. Okay, so that continues to be at 18, and therefore, Anurag, I'm responding to your question that, and I'm thankfully I'm neither a corporate agent nor an insurance company, but I expect that there will be some pressures, because if all the pressure is on the manufacturer, then it's going to be hard, right? Like Nilesh mentioned. And therefore, to respond to your question, I feel, especially on the big players in the health space, which is the fastest growing segment in our industry, I think there has to be some discussion to be done on rationalization of commission or sharing the hit, because otherwise that's the single biggest cost. If that acquisition cost is not addressed, then the impact can be quite severe.
No, we
And
are lucky
yes,
that
like Nilesh mentioned, a lot of discussion that has already begun on internalization and reversing outsourcing, building efficiency and capability internally.
Right. Right. So we are starting to get a lot of very interesting questions, and I know we've set the time here till about 7 o'clock today.
But there's
So
an important question I wanted to ask Prasoon on motor, because whatever discussion I've heard that the impact on motor is very small. I want to pick Prasoon's brain on the impact of motor, and so there's a first order impact that the GST, of non-availability of input credit reduces the profitability. Is there a second order impact, Prasoon, on motor of the GST, reforms? Do you think motor is
Yeah,
going to be impacted in some way?
yeah. Thanks, Anurag, for asking that question. So yes, of course, the uh, currently the process is the IDV, the insured declared vehicle, which is on which the premium rates are applied to derive the premiums. I'm talking about the OD. That IDV includes GST, and if the GST drops, of course, now the motor vehicles, as I said, across vehicle segments, there have been drops and in different magnitudes. So there will be an impact to that extent. So what happens is uh, the loss ratio, straightaway loss ratio impact, which means the loss ratio, which have the losses will remain as it is, does not change. But the denominator, which is the premium, so that gets impacted. To that extent, the loss ratio definitely goes up. And when you look at this, of course, you can further go deeper, and what the company should do as an analysis, look at their exposure to these segments: private car, commercial vehicles, two-wheelers, and the impact will be severe where you have more exposure towards segments which have higher OD component, own damage component, versus if you have exposure towards say segments like commercial vehicles where the own damage component is much lower. And so that's it. And I think it depends on, and there will be variation. There will be differences in the impact across companies depending on what kind of segment they write, what kind of portfolios they write. And yes, I think there are, I think, to offset this at the industry level, there are some talks in terms of we all know that there have been a lot of inconsistencies and disconnects across players in terms of the depreciation grids for the IDV. Now it's high time that we rationalize and get into more logical common understanding of those IDVs and the depreciation grids to kind of minimize as much as possible that kind of impact.
Thank you, Prasoon. I mean, somewhere around the discussion, this point was getting missed out, and so I thought it is important that we get this point out as well. And for the people from other industries, I'll quickly take 30 seconds to explain. The GST on automobiles has been reduced from 28% to 18%, and in some cases from 18% to 5%. What that means is the purchase cost of the vehicle goes down. The purchase cost of the vehicle goes down. You apply the same percentage of premium on that cost, your premium amount goes down. The claim costs remain more or less same, except in case of a theft of a vehicle, when you have to pay the entire amount. Otherwise, 95% of the claims cost remains same, which means for new vehicles, the loss ratio for new vehicles, the OD loss ratio could go up by about 6 to 7%. The impact on vehicle price is about 6 to 7%, which means the premium realization for new vehicles will go down by 6 to 7%. It's translating to a significant amount, and unless the premium is corrected, the rate is increased on a reduced value of the vehicle, or the commissions are reduced, the motor also can see a significant reduction in profitability. Thanks,
right.
Prasoon, for bringing that point.
Right.
Over
So
to you.
very interesting conversation so far on all of the premium and pricing, and I can see a lot of questions coming in from our participants as well, with respect to how the premium and the pricing actuaries need to sort of rejig their roles and how to manage the long term and the short term nature of it. So maybe I'll pivot a little bit to talk about the long term and short term together. And Pritesh, if you could come in and maybe just talk about how actuaries are now going to manage what something that was talked about earlier by Piyush as well, that actuaries now need to sort of balance the existing book, which has a long tail, along with the new book where we can reprice, but then there's a government sort of view that benefits need to be passed on, and we were talking a lot on the pricing getting impacted. So two questions there from the audience. What is the role of the actuaries in terms of this pricing, and how we need to move ahead with GST? And second, what it does to the long and the short tail of the pricing and margins.
Thank you. Before I respond, I think put my caveat. The view I express is my personal view and doesn't represent the view of my employer and what we are doing as a company. So purely personal view. I think role of the actuaries, particularly in the pricing, always been remain challenging, and I don't see that there will be any changes going to happen because of GST. If as an industry, if we look into, and I can go by right from 2005 itself, IRDA keep issuing the guidelines, changes happen, dynamics also changes. Company used to write higher surrender charges, high relief charges, and then regulator keep coming and passing on the benefit to the customer. And we as a profession, as an industry, will keep supporting them. So I don't think there will much challenge will come in. I think as a profession, actually they are equipped to handle those pressures. And I would say not a person. I think for actually, if you look to my personal view, it is an opportunity for the actuaries working the pricing function particularly to come forward, optimize the design and the pricing skill that can support to the company, and that eventually in meeting minimizing the impact of GST, and that ultimately will help to the consumer, because consumer will end up paying lesser premium. Otherwise, if you not come forward and not support that, then company would not have any option but go and increase the premium, which will adverse impact and long-lasting impact on the. This is the opportunity as a profession, as an industry we got, where government is giving these things. So we should come forward and pass on them. Second point, I will say that as a profession or as an industry, we should look into the long-term impact. I think this is a very great move the government has taken, which is ultimately benefit to the customer. We are struggling to increase the protection, and penetration is much lower. 18% reduction in the protection is significant reduction. I've never seen any company has reduced the overnight the premium by 18%. So there will be some elasticity in the things, and I assume that if you're able to protect properly, and if you're able to convey things, I think this is the opportunity where we can not only increase the protection share, but also increase the overall business for the company. And hence, we should not be looking too much and too focused on the short-term pain. We should be looking the long-term opportunity and benefit. And if you do properly, in my view, it will be beneficiary to the industry as whole going forward. Because second point is, if you look into the percentage perspective, because we're not only the long-term and short-term, we're talking about new business and other. See, if 18% reduction in the renewal premium will definitely help you to improve your percentage, and that will result into the lower cost. So in particularly lower unit cost, actually should also consider those improvement, and while making the pricing are evaluating the probability for the current product. Coming back to long and shorter term, that the second question we are looking into, I think each company has their own business plans. We should look into how we are going to optimize. This is all about the optimization, and actually we all knew there is always been opportunity to revisit your design and assumptions or what you look into. So optimize the area where you can see there is a cushion available today to address the concern and build up the cushion for the future. I think if you do that way, we are able to come forward and help to the industry. My personal view is that this is a great opportunity, and
actually particularly working in the pricing function should consider those aspects and do that rather just passing on this benefit. Very
Right.
unfortunate as as the industry we see, we always talk about the long term and we say insurance is the long term business. And whenever if any pain come, we focus too much about the short term. So my
Right.
personal view is to look into the other part.
Right. That's a very interesting take, sir, because I was actually talking in the morning only to one of the investors and equity analysts. And one of the things they said, well, they understand that this could be a 1 quarter, 2 quarter thing, but ultimately, it will blow away after a couple of quarters. And what can insurance companies do to sort of leverage this price reduction to actually increase customer penetration and reach out to more customers? So actually, Bhavna, can I pick your brains on that? And you've been involved on the business side of thinking as well as an actuary, the technical side, in terms of how much of the price change do you think it will definitely reduce from 118 to something, maybe 105, 110, whatever that is. So how much of change in price, the elasticity of change in price to demand, do you think will commute and therefore will be beneficial, and the business changes that insurance companies can actually undertake to actually make the benefit visible to the customer as opposed to the short term, let's say, realignments and readjustments that need to be done? So if you can just chip in on that.
Thanks, Kunj. I think firstly, I'd just like to echo, the line of thought that everyone has expressed, that this is in terms of intent. I think this change that has been made overnight from going to an 18 to 0, I think that from a messaging standpoint, firstly, is great because it is saying this is not a luxury. Insurance, life and health insurance is something one should have. And we spoke that, the expectation is that a large part of the benefit should get passed on directly to the customer. Now, in terms of impact, I think from a technical standpoint, couple of things to understand is that yes, potentially the impact on new business will be a lot more pronounced because today insurance is a business where upfront costs are heavy. The impact on the back book is a lot more uh, modest. And we've seen some sort of disclosures made by the listed companies on these lines, etc. So I don't think, the impact on the back book, depending on, of course, the final notification that comes out, given some of the representations that were spoken about earlier, we'll see. But, that's an impact that I guess, companies can live with. Now, on new business, I think firstly, at an entity level, the impacts will vary from one company to the other, depending on their business mix, depending on the scale, because the direct impact of the loss of input credit will come from commission costs, which is potentially the largest for new business, on any non-commission variable costs, as well as the fixed costs, where there's a direct scale impact. Also, the lines of businesses which are, where the commission rates are higher, there, of course, the impact will be more. So the impacts will vary across companies. Fundamentally, what are the various actions, one can take? Three stakeholders: customer, distributor, shareholder. And I think we've just sort of annually been doing these impact assessments in life insurance, and where should the impact go. But yeah, I think I also see this really as an opportunity. Firstly, I think for the bigger companies and companies, where the business mix is more sort of balanced, I think even if the entire, impact is passed on, the customer will still be significantly better off. So that's, I think, definitely something whichever company can really, every company, the attempt should be to pass on as much as they can to the customer. The other, I think, in some way, this is again steering us to rationalize costs. Again, this point came up. Unfortunately, we're living in a free commission era. So again, this is a challenge, but it's also an opportunity. So really, what can we do to innovate on commission costs as well as other costs to sort of give some relief internally from a strategy perspective? There is
in the current form, there is an element of cross subsidy between, retail business, group business, again, subject to what comes out in the final notification. So really, it's the impact, how much, I think the customer should be the biggest beneficiary of this. Clearly, again, that's sort of my personal view on this. It is possible with some realignment of possibly cost structures. I say realignment, of course, not, rationalization, but even realignment can help, because in life insurance, it's also the timing of the payment, which plays out a lot. Uh, and of course, the shareholder, there will be some impact. But again, I think it's an individual call. The attempt really should be to pass on as much to the customer, because the life insurance people would agree that the benefit of scale is really the biggest benefit that a life insurer can draw, which we see in sort of the disclosures we see from different companies.
Yeah.
So yeah, I think that's
Okay. So, Divyesh, there's a very, very, very quick myth or fact question for you. There's something going on in the chat box that annuity GST rates, there's no change in annuity GST rate. Myth or fact?
It's a myth.
Okay. So, the annuity GST rates are also now exempt, correct?
Yes, so annuity is defined as a part of life insurance, and that's how life insurance companies are offering
Yeah.
that product. So,
Yeah.
so
No,
yes,
thank you for clarifying that. So, for all our listeners and speaker, audience, please listen to Divyesh there. So, annuity rates are also changing. And we are talking a little bit about back book here. Ashish, you've been involved in some of this back book assessments, and life insurance companies, all of the life insurance companies that are listed, have actually come out and quantified impacts on the embedded values as being as low as 0.2% or up to 1%. So anywhere between 0.2% to 1%, and these are all the listed life insurance companies without exception have now come out and said that. Now, that's all great for large life insurance companies to be able to do that assessment fairly quickly. But what about, the shareholder reporting folks in, let's say, the medium and small sized companies who have not yet done the assessment? So can you shed some light on, this back book assessment and how to go about this assessment? What are the things to look at? What stones to turn? What to leave behind and ignore in terms of quantifying this impact for oneself?
Sure. Thanks, Kunj. And good evening, everyone. In terms of the backbook impact, and I think it needs to be understood what are the, as a result of these GST exemption, what is that the insurance companies end up losing from a backbook perspective. The first one being, unlike, say, a new business we've been talking about, there are repricing actions. But for a life insurance company, there is that continuity of renewal premium income that one has to continue. And then there is an associated renewal commission. So that part of your cost is going to now get no input tax credit. So clearly, in simple words, your renewal commission effectively goes up by 18%. And similarly, from a perspective of the expenses for managing and servicing these policies, whatever are your non-salary related expenses, which do attract, the GST to be paid out by the companies, till date were getting offset against and the companies were able to get input tax credit. So effectively, these are the two main tranches for an in-force business that'll have an impact. Now, with regards to the financial metric, companies have come up with the disclosure on their embedded value impact. It is going to not just have an impact on your EV, first, of course. Secondly, your P&L and your profitability for the year also gets sort of a hit, and so does your reserving, and consequently, the capital requirement. I think the capital bit also is very important to be understood. So for different companies, the impact could be very different. And that's what we have seen in some of the disclosures, those have come out from some of the listed players. The impact is not just single one number, and it's a broad range-based numbers. And I think there will be, and there are reasons for it. First and foremost, it is the kind of product structures that you are selling. One, in terms of, say, example, a unit link which generally has maybe a shorter tenure and a lower commission payout will get maybe relatively a lower hit. Similarly, a product structure, say a company having a large part of their business coming from group side, wherein there hasn't been a change, though the jury is out in terms of how credit life will get treated. But what the plain initial reading says that group is out. So a company with a larger proportion of their EV constituted by group business will see a relatively lower impact. And thirdly, from a perspective of the cost structures, the inward versus outward, the outsourcing one, that also will play a role. And importantly, not just the split between the two, but overall expenses as a proportion of your EV will also have a impact. So a larger companies will definitely get a lower impact because of the expenses bit, and all the other reasons on, say, a commission for a UL will be different. So as a result, if one was to maybe answering your question directly, one was to compute it as an actuary, what maybe we need to understood, and we have also have a discussion with our tax experts to understand what sort of expenses will get taxed and not, arrive at that split of what are your loadings within your EV, the maintenance expenses, what proportion of it used to get input tax credit but will no more get it. So you then project it and then arrive at what will be that value impact. Similarly, from a perspective of say a commission which is directly 18%, it will, there is no debate there, will have to be sort of arrived at, and hence you will come out as an overall impact on your embedded value as well as on PNL. And importantly, just to maybe in terms of that capital aspect, considering the life insurance industry is already grappling with the solvency margin continuously shrinking. So that's the other aspect in terms of the outcome, which maybe in the short term will have an impact, but
no, that's very interesting. So Piyush, you mentioned this a little bit early on in your thing, and maybe I'll ask you a myth or fact question as well. So this has come up several times. Ashish has alluded to a little bit. You mentioned it a little bit as well. Myth or fact: credit life business is out or in of the exemption from GST, the group credit life business.
So definitely, I would want to resort to the fact that it's actually in between. The IRDA in their regulations seem to suggest that the ultimate beneficiary is the insured. But I think so. It is it is being construed forever as a B2B product. So the credit life product would continue to be taxable is what is the understanding of the industry, and also has been asked. As far as the update from the meeting today has also come, I think so. This would also be clarified. This they have taken it as a point, so should be clarifying it. So at least for the time being, I would want to stick out that it would be taxable, continue to be taxable. I'll of course continue with the disclaimer that Pritesh mentioned and just add on to what Ashish was saying. We did a very high level back of the envelope calculation by taking the commissions that are there within the financials. So we just looked at the schedule 3 and the schedule 4 for the LOB and tried to split it in terms of group and retail. And similarly for like depreciation, rent rates, taxes, and employee costs, which typically don't attract GST, and travel costs where the GST input tax rate is not available. When one does that, and of course there would be a significant uptick in terms of new business, and therefore premiums would go up. But if we only look at the loss of input tax credit, there could be on the numbers of FY25, there could be a possibility that for the LI sector, this number could range somewhere between 11,000 to 12,000 crores. For Sahi players, it could be around 1,000 to 1,200 crores, and for GIs, it could be around 900 to 1,200 crores. So that's what it looks like. However, like Nilesh touched upon, I think so we could see a shift. For years, we saw that because of advantages in terms of no waiting period, maternity benefit, which is what actually moved from make the shift from individual to group health insurance product. Right now, the individual being 18% cheaper, there could be a possibility of group moving to individual. Now, how that will happen is something maybe we'll see over a period of time. But yeah, those are the two thoughts, Kunj.
Right. So you
I have a
mentioned a
question
group.
to
Sorry.
on a similar thing. I have a question to both Piyush and Divyesh from a health insurance perspective. If you could give me a minute. Uh, in health insurance, also there are two kinds of group insurances. One is the corporates that buy for their employees, right, which everybody is mandatorily covered, and then the banks that buy a group platform cover, where actually individual insurance is sold on a consensus basis to each customer. How do you think, the GST may vary between these two? Will both be considered as group contracts, or the platform where the, insurance is sold individually to each customer may be considered as a individual health insurance?
Yeah, Piyush,
Yeah.
go for it.
Yeah, so I'll continue with the term that Divesh use and he's used it quite often. That see, the first one is definitely excluded. It's a group product. We are relying on IRDA for that classification. The second one, the term that he used, and I'll reiterate, is that it's just a chassis, right? So it's only there to assist you. But broadly, you look at it, it's basically at the discretion of the individual. But again, since we are relying on the IRDA definition, and IRDA in its regulation has defined that point one is employer employee and point two is non-employer employee, then we'll have to keep it simple to say that yes, both are getting excluded. Divesh, for you.
Yeah, so no, I agree, and I would add that the industries had some interaction with IRDA officials. There was a meeting 2 days back in Bombay around it on the GI Council platform, General Insurance Council, and this point was discussed with one of the IRDA officials. Of course, one must realize that this group classification for the chassis product is a disclosure classification. It's not a contractual or indemnity classification. We just disclose it as group. It gets listed as group, etc. But like I said in my opening comments, that broadly there is still an agreement that this is group because it is a product that is created by the chassis, and it's a fixed product that does not get uh, indemnified, so to speak, at the or underwritten at the individual level. Now, there are chassis products where underwriting also happens at the individual level, which become a little more complex. So if it's a purely attachment product, it's much safer. The way it has been projected, even today in the meeting, is that all group products, we should follow just the IRDA classification. Generally, the feedback was that, okay, we understand what you're trying to say. You please generate an FAQ and file with us of what your point of view on these questions is, which we are starting to draft now. And we'll file that, and in that, the view of the industry, and I'm again moving away from technical view of trying to interpret IRDA and GST, but the view of the industry is that we want the group chassis to continue as group. That makes more sense. Otherwise, because the embedded cost in a group chassis product is so high that you will end up repricing that product significantly, right? So let us keep it the way it is. It works for all. Even with the 18% tax, it may be cheaper than the repriced group chassis product. And so to that extent, we will work with the industry members to draft those FAQs and address this point for the government. We will hope that they will agree with us. Verbally, at least, IRDA officials have agreed with this view.
Yeah. So
Thank you.
we're very interesting conversation happening right now about potential arbitrages between group, individual, potential shifts in product structures and designs and so on. So Rajesh, some of the product innovations, and I know you've raised your hand up as well. So some of the product innovations or ways industry could move in unintended ways sometimes there's an intended consequence. There's a cost angle, all of that. But what are the possible unintended ways the industry could move, or customers could move, or product designs could move as a result of the incentivization that this GST change makes, and whatever else you wanted to talk about. Yeah, please go ahead.
Yeah, I just wanted to add to what Divyesh has already said. Um, all these add-on products, if you see, they are basically, in fact, priced taking into account how much the intermediary is asking for. Okay. And the price that the consumer pays is really had that much relevance there. Okay. So from that, these are in fact gets pushed by the distributor saying you won't get my primary product if you don't take this add-on, right? So that's how these are getting sold. So that's also a reason why insurance company do not see a major change in 18% will really be a reflecting there. Okay, reflection of that. Because volume is not going to be impacted whether you reduce by 18% or you keep it up by 18%. Unlike individual, where if 18% reduction happens, the sales is likely to go up. Okay.
Yeah.
In terms of product design, intended and unintended, now I do believe that there used to be some tax arbitrage, okay, which was there in terms of health product, and people launched some such products saying that you can have take OPD component, which was kind of priced at 95%, 100% kind of a thing. And that OPD component is kind of guaranteed. I think that will probably is one which will catch up, because 18% GST reduce the benefit of that product quite a lot, right? With 0%, I believe that product will certainly fly. I do believe ULIP will probably become more attractive, specifically in comparison to mutual fund, where you are still paying taxes. So I do believe these two will certainly fly. But of course, in ULIP, etc., the challenge, is that the capping is already there. So high net worth push on the ULIP is kind of gone, right? That side of the market is already captured. So very little to do on that side. But yes, the middle class will still something that you will be able to push.
Yeah. Okay.
And probably the composite licensing.
Yeah.
Along with this GST change will probably have a significantly new type of products you will be able to see.
Okay, that's very interesting. And usually insurance companies, and we're all talking about the problems we have and the problems we can solve. But one of the saviors for the insurance companies in many ways is also the reinsurer, and comes in and helps the insurers in many ways. So Sanjeev sir, can I swing to you from a reinsurance perspective? It is obviously very, very welcome relief in some ways that reinsurance has also been exempt along with the insurance, because it would have been near disaster if that wasn't the case. So it's a very welcome relief that that has definitely been the case. But in terms of the support available from the reinsurer and the capacity and all of the implications directly arising out of this GST change, do you think there is anything clever the reinsurers are doing by way of leveraging the fact that at least one component, which is the reinsurance component, also becomes exempt? And is there any thinking around how the reinsurers are now supporting the insurers in any way different than would have been the case?
As you know, as you mentioned, that reinsurance and insurance, the terminology actually in the announcement is the same, that they have used the word thereon. So basically the impact is same, at least in terms of nature. The level of impact could be different for reinsurer compared to the insurance companies. So uh, I have actually spoken to a couple of reinsurers to understand the level of impact on the back book, particularly on the existing book. So an existing book, those reinsurer which are writing more and more individual business, so they are getting more impacted compared to those who are heavy on the group business. So there's an impact. And for individual business, the impact could be around quarter to half percent, depending upon again the mix and the level of their expenses. I'm talking of Indian reinsurers, which is including the foreign reinsurance branches,
Yeah.
which are subject to GST. Uh, so that's the impact on the book. So what I foresee is that even the wide perception is there is no impact on reinsurance, it's a pass through, but the reinsurance premiums might also go up by quarter to half percent for individual business. So that's the overall impact I foresee on this. But let's also talk of positive things, because uh, when particularly these all individual products are the long-term products, right? So the more important is the impact in the longer run. So as I think most of us believe that the demand for insurance will increase, and definitely for individual life insurance products and more protection, whether it is life or health, individual demand will increase. The second is on back book. What I foresee is that persistency will also improve substantially. So as a pricing actuary or valuation actuary, we should not work in silo. We should actually look at the interactions of various assumptions. So we should not look at just what is the impact of expenses. So there will be many elements of the future assumptions which will get changed, both for insurers as well as for reinsurers. So overall, I see a good news for reinsurers because I see more business opportunities coming. And that should get also reflected in per unit business expenses, and hence there should not be too much impact on the reinsurance pricing.
Yeah. Okay.
Then there is another point on the risk side, particularly we have discussed on the group like credit life or mortgage. Uh, so maybe, yeah, the reinsurers should also look at how, because I foresee there should be some kind of repackaging coming on some of the product lines currently. For example, let's say mortgage is very much possible because that is a substantial single premium amount. So how do you assess the risk, whether the premium will change if that as against group platform, if it is comes as individual business, which is more, group is more a facilitator rather than a group policy holder. So the risk, the nature of risk might change. So how to assess, and that nature of risk might change for different line of business for different groups. So where to price is additionally, if it is in individual package, or whether the price should not be an additional cost for individual package. So that is a basically technical part of it to consider.
Right.
One more
So,
point, if you permit that, for example, there are some company level policies like CAT cover or stop loss cover. So on such covers, which are company wide, so that covers your individual and group both portfolio. So there also, wherever the premium amount is significant, so there has to be some innovation how we can split into two policies, two contracts, separate for individual, separate for group, so that individuals you are not subject to GST, and the risk doesn't change materially. So some kind of innovation is required there too.
Right. So on good times, the great thing about good times is time flies when you're having fun. So Pritesh sir, you wanted to come in about
I
something.
also wanted to ask a question to Sanjeev on reinsurance.
Yes.
Maybe after Pritesh or
Yeah.
call.
So Pritesh just wanted to come in. So maybe Anurag right after Pritesh,
Yeah.
if you can ask a question. So Pritesh, you're on mute. You're speaking, but you're on mute. If you unmute yourself.
Sorry. So actually, I was hearing this conversation from beginning. Well, I want to make the 2 or 3 points. Actually, one additional point is what Sanjeev has mentioned or what Ashish was referring to the back book. I think when look into the impact of the back book, you have to look into all possible scenario in the future, not for the one-sided or expenses. And unfortunately, we are just talking about the expense increase. We are missing the other aspect that what will happen. ULIP what Ashish mentioned that there will be commission structure, other part. I think one good point of the ULIP is because of deduction of charges and GST on account of GST will be reduced. So your FMC earning will be much more. So it will be compensated. So you'll get some of the benefit from ULIP. So in addition to the lower commission structure for ULIP, you are getting benefit. So impact will lesser. Other part, what we're looking for that we are differing to the very contradicting view that perception, I will say, not view. One side we are saying because government has exempt the individual business, GST on individual business, so premium rate will go up. And we have concern about that. Other side we are saying that group GST will be continue on the group business and hence group business will be unattractive. So I think we need to find out a way to do that. Third point that's most important is I think it's a very noble step taken by the government because most of the losses and most of the have been borne by the government. I think we are the party to the nations. We all, including the company, distribution, consultant and other, we, including employee, I think we should be work together, try to minimize the impact so that impact should go lesser to the consumers. Unless and until we do, this is a great opportunity where we can take a quantum leap for the insurance business growth perspective. And in that context, in the lighter note, I will say like we have the Deloitte people, Kunj, Rajesh, Piyush, Devesh, all people in. I think the one of the cost reduction is the GST and the consulting services that most people are looking into because we say that let's look into the outsourced activities. I think there will certain components should come from your side as well. And so not only the government, the distributor, company, employee also take together and try to minimize the impact. My personal view is we should, at this point of time, not looking too much on SAT. We should be avoid passing on this impact to the consumer and see how elasticity coming to. And if you're able to do that, I think you may not need to pass on this thing as well. That's the point I wanted to add.
Very well said. Anurag, you wanted to ask a question to Sanjeev, and then I have a
yeah.
question to Nilesh about the good time. So why don't you ask, and then I'll ask Nilesh about
I
the
will,
good times.
and then I have received a question directly from a participant on my WhatsApp. So
Okay.
if time permits, I would like to ask that question on motor as well. But
Yes.
right now, this question is to Sanjeev. Sanjeev, from general insurance and health insurance perspective, general and health insurance companies place significant quota share business of health insurance with reinsurance companies, and they get a decent commission on that to compensate for the commission costs as well as for their administrative expenses. Now there is a pressure on the administrative expenses of both general and health insurance companies from the health insurance perspective. Do you think there can be demand or there can be request for a higher commission on that quota share business from reinsurance companies if things are good from a reinsurance perspective?
I think my response is this is across vendors. So this is a negative news across vendors, whether it is consultants, reinsurers, or intermediaries. So there will be some kind of renegotiations, and that will not now. It will keep on going for many quarters. So yes, actually my answer is, my assessment is affirmative, yes.
Right.
Okay, thank you.
And,
You
and
wanted
to
to
some
ask about
extent,
motor as
sorry,
well from the
and to some
WhatsApp. Please go
to
ahead.
some extent, most of the intermediaries they should support also, because at the end of the day, if volume increases, everyone benefits.
This motor insurance question is a very interesting question which I have received from one of the participants. And the question is that while we discuss about the impact on motor OD loss ratio because of the reduction in the IDV or the purchase value of the vehicles, there's also a reduction on the part cost of across automobiles. So that will have an impact on the part costs. Do you think there will be reduction in loss ratio from that perspective? To tax
So
experts.
Anurag, if I can come in to quickly answer that.
Sure, please.
The GST on parts is not a part of claim cost at all, even today. Because we are able to take that credit. There's a clarification that addresses that point from the government. So any reduction in rate is only a cash flow piece. Also, motor business is a net GST paying business. So there is no big cash flow advantage as well.
I believe that. I wanted that to come from an expert to satisfy the participant who was asking that. Thank you.
So Nilesh, I wanted to talk, and there's a little bit of talk about the technical aspects of the price increases and so on and so forth. But then there's a little bit of optics as well when it comes to insurance industry. And the biggest optics is the KPIs we are driven by, which is the top line. How much is our premium relative to GDP? How much is our penetration? How much is our top line growth of the industry of 18% CAGR for health and so on and so forth? How much of that are you thinking about, in terms of, let's say, converting all of this, whatever the price increases are, whatever the demand side pulls are, how much of that do you think is actually going to then just give you a bump up in the optics of the top line? Even if it is just some of the GST coming into the premium, but then it's premium at the end of the day, right? And comes into the top line, what comes into the optics?
So Kunj, one is, what kind of price increase and whether the industry will take a price increase, what components of the cost will be shared across, we'll have to see. But yes, if we take a price increase, there will be a bump up in value. But what the industry is lacking is the volume growth. The 5.25 crore, which has moved to 5.6 crores lives under retail health insurance, that's a stagnant figure if you look at the last 3 years. I think what the industry needs is volume increase, because insurance is a law of large numbers. The same customers buying higher value policies or paying the higher premium and claiming is not helping anyone. So I think volume growth is something which the industry should target and achieve. It's the time to move to tier 2, tier 3, and tier 4 cities, focusing on urban and metro cities. So while value growth will come if participant take up price increase, but I think the bigger benefit should come from volume growth, which should help the overall industry.
And do you see that demand pull happening as well with this going on, or at least hoping for it?
No, absolutely yes. I mean, whatever inquiries that are coming through, whatever the telesales setup that we have, 2,000 people, we see an increased inquiries, and we believe it should push the growth of health insurance and the volume growth, not the value.
Okay, that's great. I've heard some amazing perspectives. We've heard positive news. We've heard some concerning news. We've heard Pritesh say, "Why are you only talking about insurance industry? Also talk about all the advisors sitting here." And I've already started receiving WhatsApp messages from some people saying, "Okay, that's a good point that Pritesh just made." And thank you very much. I'm very conscious of time, so. I would, welcome like a free comment almost from any of the participants before we close. In case there's anything else that we need to be talking about. Yeah, go on, sir.
Yeah. So just 10 seconds. One party which will be clearly a beneficiary is the cross-border reinsurers doing long-term life and health insurance business. So there is no adverse impact at all. It's only positive benefit to them.
Okay, that's wonderful. So hopefully some price decreases there then, sir.
Yeah, they are likely to be more competitive compared to domestic reinsurers.
Right.
On that line only, long-term individual and health insurance.
Okay, that's wonderful. So at one point we touched 300 participants. So thank you very much for all of those 300 participants to partake in this experiment. We've done it for the first time at the institute, where we've just gathered around almost impromptu and said, okay, we're gonna have a little bit of a chat. And I want to particularly thank our external speakers, and I can't thank you enough, Piyush, Divyesh. Thank you very much for busting all the myths and getting a lot of your insights in. And also thank you, Nilesh. Your insights, your point of view was very, very welcome. Obviously supported by Anurag's encouragement and support. So thank you very much for that. And thanks, of course, to Bhavna, Ashish, and Pritesh sir, and Rajesh, as well as Sanjeev. I mean, all of you I know very dearly, and I hold you close to my heart. So I don't need to thank you, but I still do. So thank you very much, everyone. There's one excellent volunteer that we've had. We've had Bhavya, who's volunteered to actually transcribe all of our conversation and actually turn it into key takeaways. So thank you, Bhavya, for that, and we look forward to your key takeaways. And Piyush, Nilesh, Divyesh, thank you very much again, and see you all. Hopefully you've enjoyed it, and hopefully we can have more sort of fun conversation. I really didn't get to know of the time I was having that much fun.
Thanks,
Okay.
Kunja.
Thank you, Kunj.
Thank you.
Kunj, I would just like to take this opportunity to thank everyone. It was an amazing interaction. And I just had one takeaway, that this is a sort of an inflection point for us in the industry. And there is a need for all of us collectively to take a quantum leap to take insurance to the next level. A bunch of other things that I saw and I noted down, but I know we are running out of time. So I just took this one key takeaway. I think it sort of sums up everything very well. And big thanks to all participants for such an extremely lively discussion.